Hello students, welcome to class. In this class, we'll be picking up from where we stopped in our last lesson and we'll continue our topic on capital. However, in this class, our focus will be on working capital. Our objective for this class is to know the importance of working capital, the calculation of working capital, and also the meaning of profit. We'll be looking at the accountant's view of profit, economist's view of profit, and layman's view of profit. Now let's start off with the importance of working capital. As we've explained in our previous lesson, working capital is the ready and available funds for business daily transaction. It is also known as cash at hand. It is the money available for the payment of wages and salaries, buying of raw materials, transportation, and every other day-to-day expenses. So what are the importance of working capital? 1. It helps to determine the funds that will be available for running a business. 2. Working capital helps to know if the business is solvent or not. That is, to know if the business has the ability to settle debt without selling fixed assets. 3. It serves as a check against holding down too much money for current assets. 4. Working capital is a sign to show the healthiness of a business. Working capital helps an investor to know if to invest in a business or not. 5. Working capital helps to determine the funds that will be available for running the business on a daily basis. And 6. The lifespan of any business is dependent on working capital. And lastly, working capital helps bankers to determine either to grant loan or overdraft to customers. Now let's take a look at calculation of working capital. Let's take for example, company ABC owns and operates a stationery shop, and this is their current assets: cash $10,000, accounts receivable $5,000, and inventory $15,000. While their liabilities are the current liabilities: accounts payable $7,500, accrued expenses $2,500, and other trade debts $5,000. To calculate for working capital, the formula is current assets minus current liabilities. That is, the total of current assets minus the total of current liabilities. Now, current assets, that cash is $10,000 plus $5,000, which is current receivables, and $15,000 inventory. This makes it $30,000 current assets. While liability is accounts payable $7,500, accrued expenses $2,500, other trade debts $5,000. This makes it $15,000. So working capital equal to $30,000, which is the current asset, minus $15,000, which is the current liabilities, equal to $15,000. Now, since company ABC's current assets exceeds our current liabilities, our working capital is positive. This means that company ABC can pay all of our current liabilities using only its current assets. In other words, company ABC is a very solid and financially sound business in the short term. Before we end this class, let's look at the meaning of profit. I'll be taking a look at 3 points of view. The first one is the layman's point of view. To the layman, profit can be defined as the financial gain or benefit which a firm realizes from its business or transaction activities. Profit also relates to the gain resulting from investing one's capital in a business. The purpose or motive of any business is to make profit, and we've established that already. Next is the economist's point of view. To the economist, profit is the reward an entrepreneur gets for risks taken in starting a business or a company, while to the accountant, profit is the excess of income over expenditure. The accountant views profit from two perspectives: gross profit and net profit.
And now let's do a quick exercise. Question 1. Give 6 reasons working capital is important to a businessman. Question 2. Explain the concept of working capital. Question 3. Define profit. And question 4. How does an accountant see profit? Good luck.
With this, we've come to the end of our topic, which is capital. In our next class, we'll be looking deeper into profit. See you there. Thank you for watching. Bye bye.